5 minutes as many people are yet to join. Thank you for waiting. Hello, good afternoon, everyone. First of all, thank you for accepting the invitation and joining us on this webinar on transfer pricing. To begin with, we would like to share our sincere gratitude to all the participants who has joined our first webinar on corporate tax, which was held on January 19th. We had over 400 participants and the session lasted close to 2 hours. We have been getting requests from our participants that they need a record session of our previous session. So we are glad to announce that we are in progress and will provide you the same. We would also like to request you to join our LinkedIn page to get more updates on our future sessions and other relevant matters related to UAE. We, Jaxa Chartered Accountants, have been in practice in UAE for past 16 years with a current staff strength of 80 professionals. We cater to the audit, accounting, and tax compliance needs of over 1,500 clients across the UAE. We are an ISO 9001-2015 certified firm and the sole member of TIAG in UAE, which is an international alliance of high-quality accounting and audit firms, which has its headquarters in United States of America. Now, for today's topic, we have transfer pricing, which is commonly referred to as TP. Transfer pricing is an integral part of corporate tax to be implemented in UAE on June 2023. Owing to the importance of this topic, we, transfer pricing team at Jaxa, are conducting a separate session for a detailed discussion on the above. Transfer pricing will be a mandatory requirement for all the companies who are having related parties, connected people, and transaction with such parties. To begin with, we would like to introduce you all the speakers for today. First of all, we want to introduce CA G.V. Joseph, who is one of the founding partners of Jaxa Chartered Accountants. Sorry, 1 second. Thank you for waiting. He is a fellow member of Institute of Chartered Accountants of India and has an extensive knowledge in areas of audit and assurance services and tax-related matters in the UAE. He has been in practice since 2002 and has gained extensive knowledge in the areas of UAE's economy and accounting and auditing practices in the country based on his last 20 years of experience. Next, we would like to introduce CA Amit Agarwal, who is a qualified chartered accountant along with a master's degree in finance. He is also a qualified lawyer who has completed his LLM from San Francisco, USA. He is an accredited valuer accredited from Insolvency and Bankruptcy Board of India. His previous organizations include Deloitte, PricewaterhouseCoopers, BM Advertisers. Amit has over 14 years of experience in the field of transfer pricing, mergers and acquisitions, international tax-related matters. Last but not the least, we have Ms. Anjal Kapoor on the board. Ms. Anjal holds an MBA degree in finance and is a qualified lawyer. She possesses over 11 years of rich professional experience in transfer pricing and has been providing services to leading multinationals across a range of industries such as consumer durables, telecom, pharmaceuticals, software, IT-enabled services on various transfer pricing matches such as free-trial transfer pricing documentation, transfer pricing structuring, litigation, and advertising work. Without any further delay, we would like to begin with our presentation. We will be having a short Q&A session after our presentation. We request all the attendees to post their questions related to the session. We will address some of these questions after this session based on our available information. All the unattended questions will be taken care of, and you will be having it in your registered email ID within next few days. So we urge you to post all our questions on your Q&A box. We are ready to assist you. Our contact details will be displayed on this slide after this presentation. So to begin with the presentation, I would like to invite CA Mr. GB Joseph to moving forward.
Thank you, Ada, for the introduction. Once again, good afternoon, everyone. Hope everyone is enjoying the rainy afternoon today. Hope it will not affect our meeting. Hope everyone will be attentive, because this is one of the important topics in the new corporate tax regime. We already conducted a webinar last week, and we went through the important sections in detail last week. It was a session which extended for almost 2 hours. But this transfer pricing is one of the key aspects of the new corporate tax regime, and hence we decided that we will conduct a separate section, especially for this one, immediately after our first session. As I said, in the new corporate tax law, which was actually published on December 19 to the general public, they have included provisions related to transfer pricing regulations. Why they are introducing these transfer pricing regulations? It is just to avoid any abuse of related party transactions by companies to reduce the tax liability. The purpose is to make sure that the transaction between related parties are carried out at arm's length prices. And this arm's length prices will be determined by reference to the market value. This is the general overview about transfer pricing regulations. So, as I said, when I was going through the law to find out where all they have used the term transfer pricing or arm's length prices, etc. Actually, I was surprised to notice that these words are used in more than 10% of the articles of the law. So this indicates how important is transfer pricing in the corporate tax regime going forward. So we should also all should be ready with, what is transfer pricing, how it may affect your business. As we said in the last meeting, actually the law is effective from October 10. So these transfer pricing regulations are also effective starting from October 18, 2022. So this is effective already. And in Article 61, where it says about the provisional regulations, it clearly says that you should close the immediate previous financial statement prior to the first financial statement for tax period using the arm's length principles if you are related party transactions. So it is very important that you follow transfer pricing regulations right now.
I think we move to the next slide, and very rightly said, transfer pricing is the most important part which will hit the Dubai corporate tax regulations. So corporate tax is 9%. It is just the rate. But then there are transactions which could be routed from the profit and loss account of the balance sheet to related parties and connected person that can impact the 9% tax. And that is where you will find increased litigation as well as questions from the Dubai Tax Authority on whether you are reporting the correct 9% profit. And that question gets answered from your transfer pricing policy. This is what we are discussing today.
Okay, let us understand what is transfer pricing. Transfer pricing is a process of analyzing that a transaction or an arrangement between related parties or connected persons meets the arm's length standard. If the results of transaction or arrangement are consistent with the results that would have been realized if the person who were not related parties had engaged in a similar transaction or arrangement under similar circumstances. This is the definition. So let us analyze by taking an example. Suppose company A, they have a contract, a service contract with an independent party, and the value of consideration in that contract is suppose 100,000 dirhams. And the company A may have a similar contract with one of its related party, a group company. Okay, the transfer pricing rule says that when you decide or when you fix the price with the related party, it should compare the what was the price which they charged to the independent party for the same service, and you should use the same price while determining the transfer price with that related party. This is the essence of the transfer pricing regulations. And this transfer pricing regulations will apply to all businesses. And it will be applicable to both regional and abroad activities, resulting in both domestic and international transfer pricing. It is applicable for transaction between a free zone company and a mainland, as well as a transaction with a foreign related party. And now let us understand the terms related party and control. A related party, by definition, is an individual or entity who has a pre-existing relationship with a taxable person through ownership, control, or kinship or affiliation. Kinship and affiliation are applicable to natural persons. The decree has specified certain situations where the parties involved would be treated as a related party. Let us go through one by one. The first one is regarding individuals. Two or more individuals will be considered as a related party if they are related to the fourth degree of kinship or affiliation, including adoption or guardianship. Can you move to the next slide where we have created a tree to explain the kinship relationship. So for kinship means blood relation. So it will go up to fourth degree. You can see or analyze the degree of relation through the different colors. On right side, you can see the different colors. So your great grandparents will be the fourth degree upwards, and your great grandchildren will be the fourth degree downwards, and on sideways you have first cousins, great nieces and nephews as fourth degree. The law has included a wider term called affiliation, and they said affiliation includes adoption or guardianship. Okay, this affiliation definitely it will include marriage, but we don't know whether they are going to give a more wider meaning for that one to cover maybe, as we know, living together, etc. is becoming very common. So maybe they are planning to include that one also. We need to wait for ministerial decision to get more clarity. Can you move back? See, in case of two or more legal entities, where one legal entity alone or together with a related party directly or indirectly owns 50% or more of the shares of the other company or controls the other legal entity, then both legal entities will be related party. If a person has a permanent establishment, then the person and its permanent establishment will be related party. In case of an individual and a legal entity, where the individual alone or together with a related party directly or indirectly owns 50% or more of that legal entity or controls that legal entity, then the individual and the legal entity will be a related party. And in case of two or more legal entities, if they have a common shareholding, like if a person alone or with a related party directly or indirectly owns 50% or more share of each of those legal entity or controls them, then those legal entity will also be related parties. Again, if you have a unincorporated partners, all the partners in the same unincorporated partnership will be related party. Similarly, trustee, founder, settler, or other beneficiary of a trust or foundation and its related parties will also be related parties. Now let us understand what is control, because if you see the definitions, it says about control. So control as defined in the law is the ability to exercise 50% or either any of the four conditions. If they satisfy, then it will be deemed as having control. So the ability to exercise 50% or more of the voting rights of another person, or has the ability to determine the composition of 50% or more of the board of directors of another person, or receive 50% or more profits of another person, or determine or exercise significant influence over or the conduct of the business and affairs of another person. Here, I would like to discuss a unique and a common scenario in UAE. And we know until recently in UAE, for a limited liability company, the 51% shareholding should have been with a UAE national. It was a must that 51% of shares of a limited liability company is held by a UAE national. This was removed a couple of years before, but still many companies continue the same practice which was there before. So now we have two questions. The UAE national shareholder being owner of 51% shares of the company, but mostly, as we know, it is like an arrangement only. They are just silent partners, or they will not be an investing partner, or they will not have any interest in the company. And even many companies might have created side agreements to get the waiver from them for the claim of profits, etc. So there is a question whether they will be considered as a related party. We will say that yes, at least maybe if the amount is very small, maybe the tax authority maybe will take a more lenient approach and will consider that okay, it is following the transfer pricing rules. But if the amount is more, surely you should be taking you should be giving enough consideration to the transfer pricing rules of the law. The second question is the expatriate shareholder. He does not have 50% share capital. Will he be a related party? So then we need to look at the fourth condition here. Normally, the expatriate shareholders will be managing the company. They are the real owners. They will have the full power to conduct the business of the company, and hence they will have the control of the company, and hence they will also become a related party.
So
now,
very important here is for everyone here, the first step in your business is to identify whether in your company, do you have a related party that is in control, or do you have a party that is considered as a connected person? As explained by GB, the connected person can even be a director, can even be a person holding 5% shareholding, but because of the arrangement, he controls more than 50% of the profits. So any payment, interest, dividend, salaries, management fee received by the connected person from the company will be subject to transfer pricing. When I say subject to pricing,
we are not defined by the connected person. We are talking about the related party. Actually, the law defines, Article 36 defines the term connected person. It is very new and specific to UAE.
Yes.
As we know, in the absence of person income tax in UAE, excess payments to individual owners of the taxable business, either to themselves or person connected to them, or related parties, are likely to erode the tax base of UAE corporate tax, and hence surely the authority will be interested in controlling these payments. So Absolutely. If you read the Article 36, it says that any payment or benefit made to a connected person will be allowed for deduction only if that payment or benefit is matching with the market price of the services he provided and is attributable only and exclusively for the purpose of the business. So this is very important. These two conditions should be met. any consideration, like Mr. Ahmed was saying, if you pay any kind of consideration, it should match with the market rates. And he should be acting only and exclusively, or the services are provided in connection with exclusive business of the taxable person. If a connected person, or if a person has, if an individual has different company, and if he takes like remuneration from every company, then it may not be allowed for deduction, because the authority may conclude that he is not doing exclusively for the particular taxable person's business. So let us understand connected person before maybe discussing few more points. Mr. Amit can give more input maybe. But the connected person is defined as an individual who directly or indirectly has an ownership interest in or controls the taxable person. As he said, even they are not mentioned any percentage of interest. And a director and an officer of the taxable person, and where the taxable person is a partner in an unincorporated partnership, any other partner in the same partnership is also a connected person. And any related party of any of the three is also a connected person. So it is, I mean, being in audit industry, we already got a lot of inquiries from our existing clients. See, can we reduce our tax payable, or can we reduce the taxable income by increasing the salary to our shareholders? So this is where this clause is very important. You cannot arbitrarily increase your salary. You need to consider the transfer pricing regulations.
This was seen to be very easy to avoid UAE corporate tax by just paying high salary, because personal tax is 0. But now you corrected, GB, that because of this connected person law, which is specific only to Dubai, it would not be easy, and we need documentation, transfer pricing, as well as be ready for questions. So we have to be careful of this aspect.
Yeah. So now, up to now, I just gave a brief idea about transfer pricing regulations and various clauses included in the new corporate law. So now we will hear some technical aspects of the transfer pricing regulations. For that one, we have experts with us who are basically practicing or doing with transfer pricing documentation in India for some time, because transfer pricing was there in India for some time. So they are the experts who can educate us regarding the various technical aspects related to transfer pricing regulations. So I hand over to Mr. Amit Agarwal, and Ms. Anchal also.
Thank you, GB. And hi everyone. I am an expert on transfer pricing, handling transfer pricing for almost like 16 years in India. Indian transfer pricing law is approximately 20 years, so we have significant experience. The law in Dubai is broadly same in terms of the methods that we use for transfer pricing. If I move to the next slide, please. I request to move to the next slide. Yes. Now, when GB mentioned that first we find who is the related party, we first then find whether the related party has control, and then we also identify connected person. Once we have done that analysis, we now know that when you make payments to these related parties, when you receive money from these related parties, then that transaction, whether a management fee, goods purchase, interest, dividend, everything has to be as per market determined prices. That is known as the arm's length price. Now, how do you know what is the right price, the market price? That is where the transfer pricing methods come into play. There are 5 methods in transfer pricing. The Dubai current law, the current taxation law in Dubai is silent on the methods, but as per our experience, these will be the 5 methods which will be used in detail by which and Ministry of Finance would lay down these methods only. These 5 methods are already there. They have given the broad names of the method, but the details will come later. So the 5 methods are the comparable uncontrolled price method, the resale price method, then comes the cost plus method. These are known as traditional transactional methods. And the other two on the right side is the transactional profit split and the very popular method, transactional net margin, also known as TNMM method. Under the current law, these methods names have been provided, but the details are not given, and it would be provided by the Ministry of Finance. The Ministry of Finance said that there is no specific choice of the method. You can pick any method depending on the facts of your case. When you read these methods, you would be then asking, what are these methods? Which we would take you through the methods. And if we move to the next slide, please. One second, Priya, please go ahead. So Priya will take you through the next slide.
So the first traditional transactional method is CUP method, which is the comparable uncontrolled price method. So in this, basically, we compare the price charged from a property that we transfer or service provided in a controlled transaction with the price that we charge in a comparable uncontrolled transaction. Uncontrolled transaction basically is a third party situation. So we compare the prices with the related parties and with the prices that we charge from an unrelated or a third party. Now there are two types of CUP methods typically. One is an internal CUP, okay, and the other is an external CUP method. So let me just give an example to explain the two types of CUP methods. First is internal CUP. So basically, if I take an example of a parent entity which is based in UAE, now that parent entity is selling some products, say product X, say an apple, to a subsidiary in India. And the parent company in UAE is selling a similar product with the same characteristics and features to a third party in India itself, right? So my point of comparison or my starting point here to determine the arm's length price will be the price at which the parent company is selling the product to third party in India. And taking that as the base, I will make certain adjustments to account for the material differences between the controlled and the uncontrolled scenario, and I will arrive at the arm's length price. So this is an internal CUP where the parent company is selling to a third party also and to a related party also. Now, external CUP.
One second, Priya. Now, just to explain this very simply, if you are selling Apple iPhones, or let's say even electronic product LCD is being sold by your company in Dubai to another Dubai company, which is your related party, or in India, first thing we want to know whether you may sell that similar LCDs to a third party. So once you know if you're selling to a third party at let's say $100, then we can say that $100 is the price at which you sell the same LCDs or the LEDs to the related party, subject to adjustment, because to the third party you may be selling 1,000 pieces, but to a related party you may sell 100 pieces. So their adjustment is required, but principle is we make a comparison. That first we take the base of the third party sales. Right, Priya, go ahead.
Right. Moving on to the second method under CUP, which is the external CUP. So basically taking an example, same example, if the parent company in UAE is selling, say, an Apple iPhone to its subsidiary in India. So what we do is, now suppose we don't have an internal comparison of the subsidiary selling a similar product to any other third party. So what we do is we move on to the external comparables or the market comparables to identify companies, say a company in UAE itself, which is selling a similar product with similar features to an Apple iPhone to third parties in India. So instead of taking an internal price, like the price of selling the Apple iPhone to a third party, what we do is we pick up the price at which a third party company is selling a price to another third party in the same market. So that is external CUP. Okay, so moving on. So this was cup method basically. The second method is resale price method. So here basically, RPM evaluates the arm's length nature of a controlled transaction by reference to the gross margins realized in a comparable uncontrolled transaction. So basically, this typically happens in a situation where I am purchasing goods from a related party and selling it to a third party, right? So here basically, if I look at this example, now suppose there is a distributor in UAE. Now what it does is that it's purchasing some, products from its associated manufacturer, which is a related party, and it is selling it, the same product, it's selling it to a third party in, another market. So what I do is now the resale price, the price at which I'm selling the product to a third party becomes my resale price. Now what I do is to that resale price, now I have to look at a margin that the distributor will earn for the function that it is performing. I mean, the distribution function that it performs for purchasing purchasing a good from the, the related party and selling it to the third party. So what I do is I try to identify companies or uncontrolled comparables where a distributor is performing a similar function, and I try to identify the markup that the distributor is earning in basically, the market for such function, the distribution function. And I identify that gross margin and the resale margin basically. And my transfer pricing basically, or the arm's length margin, will be the resale price at which I'm selling the product to third party, and I deduct my resale margin, which I'm earning for this function, and I arrive at the arm's length margin. So this is typically the resale price method. The next method, if we move to the next slide, is cost plus method. So cost plus method is basically applicable in case of manufacturers or service providers engaged in, supply of properties or provision of services to related parties. So typically here we compare the gross profit markup on the costs. So, so basically the formula that we apply here is we arrive at the cost of production of the manufacturer, which is basically the direct as well as the indirect costs. And to that, we add a market-based markup, right? So a markup or a gross markup that we should earn on the costs or the cost of production that I've incurred. And how I arrive at that gross profit is, again, I undertake, a market search, and I identify companies who are earning, what kind of gross margins that they are earning in such a scenario or in such an industry. And I add that markup, gross markup, to my cost of production. So it's basically direct costs and indirect costs that I have incurred, plus a gross profit markup to determine the arm's length price.